Today's lecture will be on Chapter 18, Money, as well as Financial Institutions and the Federal Reserve. Well, most people know what money is. Money is anything that people generally accept as payments for either tangible goods or intangible services. Well, before there was money, and even now that there is money, people oftentimes still barter, which is the direct trading of tangible goods or intangible services for other goods or services. However, money, at least the US dollar, is very much exchanged and is desired not only in the US and throughout the world. What are useful forms of money? Well, one, it's portable, which means it's small and easy to carry around. It's divisible, so we have different bills, such as a $1 bill, a $10 bill, a $50 bill, etc. It's stable, which means not only does our government guarantee it, but other governments will take our dollar no matter what. It's durable, which means it lasts a long time. And you can see, finally, it has uniqueness. So you can see a lot of the types of markings that have been put on bills to ensure that people can't counterfeit it, so it doesn't lose its value. So let's talk a little bit about the money supply. And the money supply is the amount of money that the Federal Reserve, which you'll learn about in a moment, makes available for people. And the money supply is simply referred to as M1, M2, and M3. M1 is money that can be accessed quickly by you, such as paper money or coins. M2 is everything in M1 plus money that takes a little more time to obtain, such as money in a savings account or a mutual fund account. Finally, M3 is all of M1 and M2 plus institutional money market funds. Well, a lot of different countries have their own currencies. We have the US dollar. So Mexico has, for instance, the peso. Japanese has the yen. Many countries in Europe share a common currency called the euro. So oftentimes, the dollar will go up and down versus other types of currencies. So the dollar will either be falling in value or rising in value. When the dollar is falling, the amount of goods and services that you can buy with the dollar goes down because it's worth less. The opposite is true when the dollar is rising. Here, the amount of goods and services you can buy with the dollar increases because the dollar is stronger, it's worth more. Now, I mentioned the Federal Reserve a few minutes ago, and the Federal Reserve institutes the monetary policy in the United States. So they, in essence, control the supply of money. Now, I'm not going to make you memorize all these things, but these are some interesting facts about the Federal Reserve. There are different district Federal Reserve banks. We happen to be in District 12, which is the largest one that encompasses most of the western United States. I'm going to spend a lot of time on this slide. The Federal Reserve does three main functions with regards to monetary policy. The first thing is reserve requirements. Reserve requirements is the level of reserve funds that all financial institutions must keep at one of the 12 reserve banks. So Bank of America, Citigroup, so a Bank of America that's here in the western United States has to keep a certain amount of money in reserve at the district bank in San Francisco for the 12th Federal Reserve District Bank. So as you can see, the more money that the Fed requires that financial institutions keep at a reserve bank, the economy will slow because there's less money at the Bank of America or Citigroup to loan out. The opposite's true. When the Federal Reserve decreases the reserve requirements, that means banks can keep more of its deposits and thus loan out, speeding up the economy. The second thing that the Federal Reserve does with regards to monetary policy is open market conditions. This is the process of either buying or selling government securities or government bonds. So when our Federal Reserve sells bonds, in essence, they are now holding money. When they're holding money, it's less money out in the general populace to slow down the economy. The opposite is true when our Federal Reserve buys bonds. When they buy bonds, they're taking money in their coffers and now giving it to our government, and that is more money for such things as infrastructure that helps us speed up the economy. The final thing that what the Federal Reserve can do with regards to monetary policy is to raise or lower the discount rate. The discount rate is the rate that the Fed lends money to its member banks, such as Bank of America, Citigroup, Wells Fargo. Well, that's where they get some of their money from, is from the Federal Reserve. So when the Federal Reserve raises the discount rates, banks borrow less because they're borrowing at a higher rate. If they're borrowing less, they have less money at the bank, and thus the economy slows down because there's less money to loan out. The opposite is true when the Federal Reserve reduces or decreases the discount rate. That means it's cheaper for its member banks to borrow. They'll borrow more, they have more money now to lend out, and that helps speed up the economy. So our Federal Reserve System came into existence in 1907 based on what we called runs on the bank. You can see the picture here on the slide. Oftentimes during financial crises, people wanted to get their money on the bank and they would run to the bank. And you can see that there'd be a run on the bank like you saw on this slide. This created the Federal Reserve to help stabilize the banking system. And as you can see, we've had a lot of bank failures. Some of you are old enough in this class to remember Washington Mutual Bank that went down in 2008. Well, our banking system consists of four main types of institutions. We'll talk about these on the next several slides. But these are commercial banks, savings and loan associations, credit unions, and non-banks. The first one, commercial banks, are for profit, and they're companies that receive deposits from individuals in the form of checking and savings accounts and use those funds to make loans out to other members of the public. So a commercial bank, think of Bank of America, Citibank, Chase. They have two types of customers: depositors who deposit money in, and other people go to the bank to borrow money. Just because you're a depositor doesn't mean you can't also be a borrower. They are not mutually exclusive. So what are some of the services of these commercial banks? Well, a demand deposit, otherwise known as a checking deposit, that's the technical name given to a checking account. Money is available on demand. If you've ever written a check, it always says pay to the order to. So when you put someone's name, you're telling your bank, you're demanding your bank pay that person. A time deposit is another name for a savings account. Sometimes banks can require prior notice before you make a withdrawal, but today most savings accounts or time deposits do not require prior notice. A type of time deposit that does require notice is what's known as a CD, or a certificate of deposit. That's a type of savings account that earns a higher rate of interest than a regular savings account and must be paid back on the certificate's maturity date. Second type of banking institution, which you don't see a lot of anymore, is an S&L, or a Savings and Loan Association. They again accept both savings and checking deposits just like commercial banks, but they are known primarily to provide home mortgage loans. They're often called thrift institutions, and you don't see many of them around anymore. What you do see a lot of today is known as credit unions. So unlike banks and savings and loans, credit unions are not for profit because they are owned by their members or their depositors. And because they're not for profit, they usually offer a more wider range of services and also offer a higher rate of interest for its members. And also it usually offers a lower interest rate for loans to its members. So I know that I bank at a commercial bank, Bank of America, and I also bank at a credit union, Logix, and because I keep more money there because I get a higher rate of interest. And when I get a loan, I usually go through them because I get a lower interest rate. Finally, the fourth one was non-banks, and these are other types of financial institutions that don't act like banks. They don't take deposits. However, even though they don't take deposits, they offer many of the services provided by regular banks. And you can see here on the slide examples of non-banks. And many of you remember we talked a little bit about this last lecture about the banking crisis back in 2007 and 2008. And what happened is a lot of people bought houses that they couldn't afford. They took out big mortgages. And what happened? When the economy tanked, the value of the houses went down. People walked away from their houses because they owed more on the houses than they were worth. And now the banks own the houses. So this led to a huge banking crisis. So you cannot blame the banks, but that would be sort of a little bit naive, as there's a lot of people to blame for the banking crisis. People took out loans that they obviously probably shouldn't have ever got into. Remember, we showed the picture of the run on the banks on the previous slide. Well, one of the things that we have is insurance on banks to ensure that there's more security and you feel more comfortable keeping your money at a bank. So for commercial banks, we have the FDIC, the Federal Deposit Insurance Corporation, which insures bank deposits of up to $250,000 per person or $500,000 per couple. The same holds true for savings and loans, as well as for credit unions, as you can see on the slide. So commercial banks and credit unions and savings and loans have made huge advancements in technology. So you have things that you didn't have 25, 30 years ago, such as debit cards, and now being able to do online banking and making deposits through your phone, etc. We may be moving towards smart cards, which is a combination of not only a credit card, a debit card, but such things as driver's licenses and more. I don't know if we'll ever get to this point. I think a lot of people are worried about having too much information on one card. Commercial banks make other types of transactions outside of the country. Otherwise, and two of them are known as a letter of credit and a banker's acceptance. A letter of credit is a promise by a bank to pay a seller a given amount in another country if certain conditions are met. A banker's acceptance is a little bit more lenient. Here, the promise the bank will pay a specified amount at a particular time, whether or not conditions are met. Also, banks do exchanges of different money and different types of money. So oftentimes you can exchange your dollar for a euro or a peso, etc. Finally, I want to talk a little bit about the World Bank and the International Monetary Fund. So the World Bank was created after World War II, and the World Bank purpose of it is to lend money to less developed countries in an effort to improve their productivity and also to raise their standard of living and obviously their quality of life. Another organization that helps out is the IMF, or the International Monetary Fund. And this allows its member countries to exchange currency and allow for the free transfer of goods and services a lot easier. This concludes our discussion on Chapter 18, Money, Financial Institutions, and the Federal Reserve.